it's an anomaly, if you will, to see companies expanding margins meaningfully in Q4 FY22. And one such name which has done that in a meaningful way is GMDC, wherein the numbers were very, very strong. EBITDA margins expanded on a YOY basis almost 6 times, from 5.48% to 39.72%. But that was not all. There are fairly strong revenue performance. The bottom line performance was extremely strong as well on all counts. A very good quarter. Let's get in the management. Mr. Roopwant Singh, he's the Managing Director of Gujarat Mineral Development Corporation, joins us right now on the show to talk about the quarter and the year gone by, the change that we're seeing in the company, and whether that is sustainable in the quarters and the years to come. And how does he see the vision for GMDC? That's a lot that I'm planning to pack in the next 15 to 20 minutes, Mr. Singh. But congratulations on a strong quarter. Thanks for joining us today.
Thank you. Thank you, Neeraj.
So can I actually start off with that, sir? Stellar performance.
So those are Neeraj, those are 3-4 questions. What do we start with?
No, let's just start with the Q4 performance first. Was it largely driven by higher lignite volumes and prices? And how sustainable is that?
Volumes, prices, and cut down on things which were bleeding our company.
Okay.
So the mainstay of the company has emerged to be lignite over the past. We worked towards it. Actually, we had a diversified portfolio, but sadly, we worked towards it. So we have deepened lignite. We responded to the market. We took a call on prices, and we took a bigger call and on volumes. We really ramped up our volumes. If I talk of the year as a whole, last year we ended at 6 million. Now we have ended at 8.5 million. So we have been able to capitalize on an opportunity. We had we have a pain which was supposed to be our strength in these times, stronger or leaner, which was our thermal power plant. Now that plant had been bleeding us. From there, what we have been able to achieve, I along with my honorable chairman, Dr. Gupta, we joined in June. So if you look at Q1 to 4, it was a question of cutting losses. So we don't intend to make money from that plant now because we have an obligation to supply power. It's a running PPA. The cash burn in the Akrimota thermal power plant is down to 0 in Q4. Now, yes, we have capitalized on something, but this is just an example, which is a very visible example, where a cost center has stopped bleeding. When we joined, there were 6 cost centers, smaller, larger, which were again in the negative. Them, whatever little it can contribute. So 3 of them are in positive now. These are not big numbers, but symbolically they are important. 50, 100 of my employees stay there. Each project has a colony. That plant does not do well. That mine does not do well. It has an impact on the morale of those people. All of us are transferable. We move around. So we have worked on not only volumes, not only being more market sensitive, but bringing up the morale of our team. We have not brought on anybody new. At the most, what we can take credit for in the top management is we have made an attempt to put the right person at the right job.
Mm-hmm. Okay.
That's all I have to say.
Okay, just a quick follow-up. So I heard you say that out of the 6 cost centers, 3 have turned into the black. There are 3 more, therefore. Are these in the process, and do they kind of show some results in FY23?
Yes, these are in fact very important cost centers, and they have the rejuvenation on them will take 6 to 9 months to one end to a couple of years, and they can fundamentally alter the nature of business the company does. We have a vision internally. We want to have in the middle term, in 3 to 5 years, create a framework where at least 50% of our revenues come from non-lignite resources. Lesser volumes, more value. So that is the ambition. So these are those kind of cost centers. Work is already going on. Yes, we have enlisted the best in the world. Uh, for strategic transformation, a state PSU of our reasonable size has enlisted PCG. We, our management believes that an expensive and a detailed exercise like this, what kind of fundamental transformation it can have. So, because where you deploy the capital, yes, today we are debt free. Yes, our reserves are growing. Yes, most of our indicators are good. But one false call, one couple of 100 crores in a wrong direction, the entire story would change. We do not want to do that. We have our own plans. We have made our own calculations. We have a strategic advisor. We will run it through so many prisms that a clearer light comes out.
Okay, so we'll see some resolution there too. And I'll come to that piece in a bit. Let me just first dwell a little bit upon what's happened in the quarter and the year. So when I looked at the quarter carefully, due to some deferred tax numbers, the PAT margins were lower in Q4 compared to quarter three. Your EBITDA is at 400 crores, is about what? More than 12 times the EBITDA in quarter one FY22 as well. My question is, how sustainable are these numbers? Can EBITDA margins sustain at 35-40%? And can PAT margins be at 20 odd percent, or can they be at 15-16 odd percent?
Two answers, very quick. This kind of rise, pulling the company out of the red and growing, restoring it to its position, this kind of rise you will not see. You will see sustainability.
Sure.
With a marginal rise. That much we can assure.
Okay. So
if you look at where our PBT was, like we were 350 crores in the minus. Now we are roughly 750 crores in the plus. So the journey has been 1100 crores. So so this kind of a journey will not happen. Now what we have to consolidate on is from a PBT perspective. We have 736 crores. Yes. Where do I go from here? Yes, in the previous financial year, 2 quarters, we severely underperformed. Third quarter, we started getting our act in order. Fourth quarter is a realistic way to judge us. So we were confused and we were languishing. Now we are there. Quarter 3 and 4 are a better way to judge us, and 4 more. If you look at the price corrections, which many of the financial analysts talk of, that you keep on taking so many price corrections, why do you do it? How do you do it? And it is seen only from the bottom line profit perspective. We have fundamentally changed something. Every fortnight, we look at 15 different parameters to take a call on the price. Started towards the end of Q2, matured during Q3. And you have seen the results of it during the Q4. So we are wiser now, smarter now. Not only are we increasing the prices, we have increased the number of customers. We have improved their experience.
Sure.
I cannot claim credit for introducing e-payments, but it was not there. We were working on drafts. In this day and age, sure. We treat them better. We are here because of them. So that kind of philosophy has gone into the organization.
Got it. No, so would be lovely to talk about all of these in individual initiatives at a point of time when we have some more time, sir. Since you have paucity of time, I will try and stick to the headlines, sir. So therefore, if I look at Q3 and Q4, there has been an uptick in EBITDA margins, slight dip in PAT margins because of the deferred tax, which I presume was a one-time element. So therefore, my question, do you reckon that you could be northwards of 35% on the EBITDA margin front? And do you reckon your PAT margins could sustain at this 20 odd percent that you clocked in quarter 3?
We are both.
Okay. Now, you are a direct beneficiary of the current coal shortage scenario in the country. Lignite accounts for, I believe, 80-85% of the revenue thus far. And you've been allocated more mines as well. Can we expect an increase in volumes from where you are right now and realizations in FY23 without taking into account the additional mines? And with taking into account additional mines, can that volume growth be even better?
Yes, all of them, but how I'll do. the immediate term, in which we are in, we plan to reach 10 million tons from 8.5 million tons. This we plan to do with the existing 5 running lignite projects. Next financial year, during this year, we are going to work very hard on operationalizing the 6 lignite blocks which were allotted to us now, not 5, but 6 years ago, and they were languishing. To put a check on us to ensure that we keep on working faster, we have onboarded Deloitte. Deloitte is the PMC for Coal India. Coal India is 100 times the size of GMDC. So the same kind of rigor, the same kind of parameters, we are going to ask them to apply on us, act as our PMC and aggressively push these projects. You should see in 18 months to 24 months, these some sort of groundbreaking taking place in these mines. And once that happens, this is an ambition of our top management, my senior officers with me. We plan to cater to at least 50% of the solid fuel requirements of the state of Gujarat. Yes, we will not be easing anybody out. The pie will grow. There is space for everybody. Yes, we cannot capture all of it because this is lignite. This has certain limitations, and this will go only as far, and this will only suffice as many part of the requirement. Rest will be filled by imported coal and domestic coal, and there's space for everybody. The pie is around 24 to 27 million tons in the state of Gujarat. Different estimates vary. So that is our ambition, and that is our strategy.
So may I ask you, you moved from 8.5 to 10 million tons in FY23, presumably higher in FY24 because you've got a lot of mines, and yet you bring down the contribution of lignite from 80-85% to 50%. That would mean that the other businesses would show significant growth as well.
Yes.
Can you talk a bit about this?
That is our ambition. Lignite is coal, is a variety of coal. Yes, we need to future-proof our company. Yes, our principal product has a limited shelf life, which is not so soon as many predicting. Yes, it is going to be there for a few decades. Sustain the economies of like ours. But this is low margin, high volume product. We are good at it. So we have 2 ambitions. We will deepen lignite, which we spoke of in your previous question. And we are going to deepen our beyond lignite portfolio. So in the current year, 12 to 18 months, see activity on adding more value to our bauxite plant, our bauxite projects. We have huge reserves of silica. We have a fluorspar plant which is languishing and a mine which is closed. So you will see a lot of activities. In fact, if you go out in the market, you would see a lot of RFPs to put this entire thing in place. RFPs to sell it, spot sale, whatever things are going on. And in the medium term, what are the things which will bring a real value? One is fluorspar will have to be deepened and broadened. Second is manganese. We have found very good reserves. We plan to develop that in partnership with a central PSU, which has leadership in this sector. And we have auxiliary reserves, huge, massive reserves, auxiliary reserves in our lignite mines of limestone. These reserves are to the tune of 1800 to 2000 million tons. Now, to give a perspective, a large size cement plant, which has a 30-year life or 25 to 30-year life, is easily sustainable on a 300 to 350 million ton resource. So you discount the resources by 50%, discount it another 10%, discount it another 10%. So there is space for 2 to 3 players or partners who can come and work with us. And whatever I speak, I speak from the profitability point of view. Yes, because we are a listed company, we are answerable, and I also speak since I am a government servant, and I speak from a position of responsibility because this is strategically important. The more resource you create of these kind of resources, we are building sovereign assets. We are securing the state. We are securing the nation. Just imagine what would happen.
Sure, sure. Okay. That's impressive.
Big numbers. Sorry, Neeraj, but they are. So we will not sell anything or tell you anything. We will run it through the best consultants, the best advisors, the sector best people. A few I have named, and few we will name later.
Sure, sounds good. Since you have 4 more minutes for me, I will ask you 2 more questions. I will skip the question on CapEx. Maybe we'll do that on a later interview. I presume that CapEx will not be a problem, or funding the CapEx will not be a problem. So I'll choose to answer the other two, ask the other 2 questions. The first question is FY23 is now well known. It's written in reports. You've given a number of interviews, so on and so forth. What happens post FY23 in terms of production volumes and the other aspects? You move from 8.5 to 10, you move beyond 10, and the contribution from the other businesses comes up. So do you reckon that your revenue run rate will keep on moving up from FY22 to 23 to 24 to 25? Because I'll tell you why I'm asking this, sir. There are a few people who anticipate that while you might show growth in FY23, but FY24 and 25, the revenue run rate might slip a little bit because you are focusing on high value products and not necessarily volume.
So since we are going to diversify, we are going to start adding value to things which we already have. So deepening down on those things is easier. Volumes are less, value is more. CapEx is also very limited. We just need to run good beneficiation or value addition plans and connect to the right people.
Sure. But would that come at the cost of revenue growth? I mean, not at the cost. I don't mean that negatively. What I mean is you may choose to grow slightly less on the revenue front because you are actually doing better on the EBITDA front.
I think judge us on EBITDA because we are on a growth trajectory. Why would we onboard these kind of advisors? I have named 2 prominent ones.
Sure.
There are many others which are already working. You would have seen advertisements for onboarding full-time experts. Why would we be spending on these people if we were on a 6 or 12 months journey?
Fair call, sir. Okay, we
will judge us by our actions and our holistic actions.
Okay, fair call. My last question, and I would love to have you back again in a month's time or 2 months' time to talk in detail about the strategy you are deploying, Mr. Singh. But just one final question. We haven't quite discussed the rare earth opportunity. It's a bit of a black box. People know that you are in that space, but people don't quite know what you're doing. Whatever you can share, can you give us some glimpse about how you would be involved in that? And by when would that start showing something on the books of GMDC?
Since you have been so kind and have already committed to meet me in 2 months, so I will be sharing more details. So let us schedule it 3 months from now. What I can tell you now is this strategy is being led not by GMDC, it is being led by the government of Gujarat. And we are their principal instrument. And in this board meeting, we have agreed to onboard the phase 1 and the expense of that exercise for the rare earths strategy plan. So the strategy plan should be ready in 3 months, and then we would be implementing it. But forgive me, it's a strategic mineral, and we'd like to be more sure-footed. And I accept that invitation.
Thank you so much. I understand you have a tight schedule, so I'll let you go on that note. But congratulations on what's been a fantastic year, really, not just a quarter. And all the best for many such more.
Thank you. For us, it's been a few months only, 6 months only. Thank you so much.
But lovely having you on the show today. And viewers, thanks for tuning in.
Thank you.